At the start of 2025, the White House sent shockwaves across Canada with a jaw-dropping announcement. President Donald Trump revealed plans to impose a hefty 25% tariff on Canadian imports. The official reason? National security concerns, border control issues, illegal immigration, and the ongoing fight against drug smuggling. The news spread like wildfire, igniting an immediate uproar in Canada, with citizens, business leaders, and government officials scrambling to understand how to respond. Questions began to circulate. How should Canada react to such a bold move? Should they fight back or try to avoid further escalating tensions? Some voices called for aggressive retaliation, insisting that Canada could not afford to sit back while its largest trading partner applied more pressure. Others warned that escalating the conflict could backfire, potentially hurting Canadian businesses and workers in the process. One thing was absolutely clear. Canada wasn't about to take this lying down. Prime Minister Justin Trudeau made a strong statement, promising that Canada would not back down. "Everything is on the table," he declared, calling for unity among Canadians. On the other hand, Premier Doug Ford didn't mince words either. He floated the idea of taking drastic measures, like banning American liquor imports, or even halting energy exports to states like Michigan and New York. But here's where things get tricky. The U.S. and Canadian economies are inextricably linked. It's like a web of intertwined interests. Pull one thread and the whole system could unravel. A significant portion of American refineries, especially those in the Midwest and Rocky Mountain regions, rely on heavy crude from Canada. If Canada were to limit its oil exports, U.S. gas prices could surge, sending shockwaves through the economy. On the flip side, Canada's oil-rich provinces could face severe economic challenges, with their oil industry taking a direct hit. But wait, there's more drama unfolding across the globe. Over in Asia, China is making major moves in the oil market. U.S. crude exports to China have plummeted, dropping from 115.6 million barrels last year to just 81.9 million barrels. What's behind this massive shift? A combination of factors. China's slowing economy, a growing emphasis on renewable energy, and notably, a rising preference for oil from Russia and Iran. But that's not all. China also took aim at the U.S. with a set of retaliatory tariffs. As of February 10, 2025, U.S. crude oil faces a 10% tariff, while liquefied natural gas, LNG, and coal face a 15% tariff. This move marks a dramatic turning point in global energy politics. Once the second largest buyer of U.S. oil, China has now fallen to 6th place. That's not just a small shuffle. This is a seismic shift in global energy dynamics. For years, China has been the world's largest oil importer, pulling in millions of barrels every day to fuel its booming economy. But recent reports show a 7.2% drop in overall crude imports from last year. What's going on? A mix of factors, including the lingering effects of COVID-19 lockdowns, stockpiling domestic reserves, and ambitious plans to modernize its refineries. But here's the plot twist. Even with this drop, China is quietly reshaping its oil-buying strategy. Instead of sticking with traditional Western suppliers, Beijing is increasingly turning to cheaper and politically isolated sources, namely Russia, Iran, and Venezuela. And the numbers back this up. According to energy tracking firms like Kepler, shipments from these sanctioned nations have been on the rise. For example, a 2% increase in shipments from Iran might sound small, but when you're importing over 10 million barrels a day, that's a huge amount of oil. So why the shift? It all boils down to two things: money and strategy. With Russia under heavy Western sanctions, the country has been forced to sell its oil at steep discounts. China, ever the bargain hunter, has seized this opportunity, snapping up Russian Urals crude at prices far below market rates. Iran likewise has found a way to keep its oil flowing to China despite U.S. sanctions. Iranian tankers often go dark, turning off their tracking systems, and transfer crude to other ships at sea, particularly near Malaysia, before continuing their journey under a different name. By the time the oil reaches China, it's labeled as coming from countries like Malaysia or Oman, not Iran. Venezuela, which has been under U.S. sanctions for years, plays a similar game. Even with these restrictions in place, its oil still finds a way to flow into China, using complex payment systems and third-party traders. And since Venezuelan crude is often much cheaper than other sources, smaller Chinese refineries, especially those outside government control, are eager to buy it. China's energy strategy isn't just about securing cheap oil. It's about long-term energy security. By diversifying its suppliers and tapping into countries outside the U.S. and European sphere of influence, China reduces the risks of over-reliance on any single nation. The cherry on top? Buying oil at a discount allows Chinese refiners to operate with higher profit margins. These savings can then be passed on to domestic consumers or used to flood the market with cheap refined products, further strengthening China's economic grip in the region. Tracking these secretive oil trades isn't easy, but analysts have their ways. Companies like Kepler and Vortex use satellite images, ship tracking data, and port records to keep tabs on oil tankers in real time. Some tankers go dark by turning off their tracking systems. Others perform ship-to-ship transfers in the middle of the ocean to obscure the origins of the oil. Ports in Malaysia and Oman have become hotspots for these shadowy transactions, where Iranian and Venezuelan crude is relabeled before continuing its journey to China. Even though Chinese customs records might not officially show these barrels coming from sanctioned countries, the surge in shipments tells a different story. It's clear that China is actively tapping into these cheaper, sanctioned sources, saving billions of dollars, while completely reshaping global oil flows in the process. And the ripple effects are being felt all over the globe. Traditional oil suppliers like Saudi Arabia, Angola, and Brazil are starting to feel the pressure, with some even adjusting their official price structures just to stay competitive. This new reality is forcing major oil producers to rethink their pricing strategies. As China continues to snatch up deeply discounted shipments from sanctioned nations like Russia, Iran, and Venezuela, Western efforts to curb these oil flows are being tested like never before. And as China increasingly prioritizes affordability over traditional partnerships, it's playing a bigger role in shaping global oil prices. For Russia, China's shifting oil priorities have been both a challenge and an opportunity. After facing crippling sanctions due to its invasion of Ukraine, Russia turned its attention eastward, particularly toward China. This wasn't just about survival, it was a complete overhaul of Russia's energy strategy. By offering steep discounts on its crude, Russia quickly became one of China's go-to suppliers. In 2023 alone, trade between the two nations soared past $240 billion, with oil and gas making up a substantial portion of that figure. But Russia didn't stop there. By 2024, China completed the Power of Siberia pipeline, creating a direct energy link to Russian natural gas. And now, talks are underway to expand these supplies even further, with the proposed Power of Siberia 2 pipeline, which would redirect gas originally intended for Europe. This shift has fundamentally changed global energy flows. Russia is now increasingly dependent on China to absorb its exports, while China is securing long-term, reliable energy supplies. It's clear that China's energy strategy is about more than just the best price. It's about forging alliances and positioning itself for long-term dominance in the global energy game. Nowhere is China's growing influence more evident than in its dealings with Iran. Despite the U.S. sanctions aimed at crippling Tehran's economy by cutting off its oil revenue, China has remained an unwavering buyer, consistently purchasing Iranian crude at rock-bottom prices. These deals are not just about acquiring cheap energy. They are vital for Iran, acting as a financial lifeline to fund critical government programs, including military operations. Washington, of course, hasn't been blind to this. In October 2024, the U.S. rolled out even tougher sanctions targeting Iran's oil and petrochemical sectors, hoping to squeeze Tehran's economy further. Yet, despite this pressure, China has refused to back down. Instead, it's found clever ways to keep Iranian oil flowing, sometimes masking shipments or routing them through third parties. While the spotlight often shines on China's energy trade with Russia and Iran, its growing energy relationship with the United Arab Emirates, UAE, is also worth noting. By 2023, trade between China and the UAE had surged to nearly $95 billion, with $83 billion of that coming from non-oil goods. Yet energy is still at the core of this relationship. The UAE's natural gas exports to China exceeded $4 billion in 2023, underscoring Beijing's strategy to diversify its energy sources. And it's not just about oil. Under China's Belt and Road Initiative, China National Petroleum Corporation, CNPC, has cemented a strong partnership with the Abu Dhabi National Oil Company, ADNOC. These joint ventures are not merely about securing oil. They're about embedding China deeper into the global energy system, positioning itself as a key player for years to come. Mid-2024 saw another milestone when China's state-owned CNPC struck a landmark deal with ADNOC. The partnership focuses on exploring new reserves, ramping up oil and gas production, and boosting trade in crude oil and liquefied natural gas, LNG. But this agreement isn't just business. It's a reflection of the two nations' intent to fortify their energy bonds for the long haul. Interestingly, both China and the UAE are also focusing on a greener future. While China has long been a leader in solar technology, it's now exporting massive quantities of solar panels to the UAE, helping the nation meet its clean energy targets. This is just one part of a broader economic picture. China has been the UAE's top trading partner for years, and in 2023, UAE investments in China surged by 120%, making up nearly 90% of all Arab capital flowing into the Asian giant. But China's growing energy ties with Russia and Iran could have larger consequences. With access to cheaper oil from these politically isolated nations, China has fewer incentives to rely on U.S. oil. And this shift isn't just about price. It's part of a broader strategic maneuver to reduce dependence on Western-controlled markets. Beyond oil, China's deepening relationships with Russia and Iran also extend to trade and diplomacy, aligning with its Belt and Road Initiative, a global infrastructure project aimed at expanding Beijing's influence across continents. This push to secure energy ties outside of Western influence is not just about building economic power. It's about creating a resilient, self-sustaining system that reduces China's vulnerability to global pressures. As China continues to scale back its oil imports from the U.S., it could send shockwaves through the American energy sector. Lower demand for U.S. oil would likely put downward pressure on crude prices, squeezing profits for American oil producers, and potentially slowing down investments and job creation. Simultaneously, the ongoing trade tensions between the U.S. and China have only accelerated Beijing's desire to seek alternatives. Tariffs and trade restrictions have made American oil less attractive to China, pushing the nation to seek cheaper, politically neutral sources. This shift could also have serious repercussions for the U.S. trade deficit. As China reduces its reliance on American oil, it could contribute to widening the trade gap, further straining an already delicate economic relationship between the two superpowers. China's rise as the world's top oil importer is a testament to its rapid industrialization and evolving energy strategies. With daily crude imports now surpassing 10 million barrels, China has long shaped global oil demand. But as it diversifies its sources, secures cheaper alternatives, and invests heavily in renewables, the global energy landscape is shifting beneath our feet. Looking back, China's energy journey took a dramatic turn in the early 1990s. After decades of self-sufficiency, China found itself consuming more oil than it could produce. By 1993, domestic production could no longer keep up with the booming industrial demands, and for the first time, China had to start importing oil. Initially, it turned to nearby Southeast Asia, but that was just the beginning. As China's economy surged in the 2000s, propelled by its entry into the World Trade Organization and massive infrastructure investments, oil imports exploded. By the end of the decade, China was bringing in over 4 million barrels of crude every day. In response, China expanded its pipeline networks and refining capacity, ensuring it could process even greater volumes of crude. By 2017, China overtook the U.S. as the world's #1 oil importer, increasingly turning to Russia and Africa for supply diversification. By 2023, China was importing a record 11.3 million barrels of oil daily, solidifying its position at the top of the global energy market. But it's not just about securing oil, it's about playing the long game. Instead of relying on U.S. crude, China is deepening its ties with Russia and Iran, not only to access cheaper energy, but to reduce reliance on American-controlled markets. The ongoing geopolitical shifts, fueled by Russia's war in Ukraine and sanctions on Iran, have further opened the door for China to secure oil at discounted prices. By embracing these less conventional suppliers, China is reducing its exposure to trade pressures and insulating itself from potential sanctions. To make things even more interesting, many of these transactions are now being carried out in non-dollar currencies, challenging the decades-old dominance of the petrodollar system. This retreat from U.S. oil isn't merely an economic shift, it's a bold geopolitical move. If China continues to reduce its reliance on American oil, it could lead to a glut in the U.S. market. That might seem like a win for consumers, but it could spell disaster for oil producers. A reduction in demand could push prices down, decimating profit margins, discouraging investment, and even leading to job cuts within the oil sector. And that's just the beginning. Strengthening ties with BRICS countries, Russia, Iran, and beyond, could ultimately help China form a new economic bloc that operates outside of U.S. influence. This could erode Washington's leverage in global energy markets, diminishing the effectiveness of sanctions and reshaping the global economic balance. For the U.S., the risks are clear. Petroleum is a major export, and a continued decline in Chinese purchases could put further strain on the trade balance, escalating tensions in an already complex economic relationship. China's strategy is clear: secure long-term energy independence, diversify its sources, and reduce reliance on U.S.-controlled markets. As it redefines global energy dynamics, the balance of power is shifting, and it remains to be seen just how far this new energy world order will reach.